There is no way to sugarcoat it. The trading on Friday was ugly. We came into the week like a lion, up 1.8% on Monday, and went out like a lamb, down close to 2% on Friday, with all but one sector, utilities, in the red. Markets are clearly pricing in a wide range of outcomes, and that uncertainty is showing up in lower prices for stocks. Make no mistake, this is a very different market and demands a different playbook. Monday will lock in the first down quarter since Q4 2023 and the second down quarter since the start of this bull market. There's a lot of questions, and for the moment, there aren't a lot of answers. There is a wide range of debate regarding what's taking place in Washington. The downsizing of government, DOGE, and tariffs. Some love it, and some hate it. But what isn't up for debate is that it is happening. Complacency and hysteria have no place in the decision process. The truth rarely lives on the extreme, and my job, our job, is to dive in and find that truth. Welcome to The Money Runner. I'm David Nelson. Last week, we discussed the momentum sell-off as hedge funds reduced their exposure and its similarity to unwinds we saw during the financial crisis. The question is, where did all that capital go? Some of it went into international markets, some into fixed income, but the bulk of it went into low and no growth stocks, some paying a dividend. Now, there's nothing wrong with that. In fact, it can be a good place to hide. But now, as you can see in this chart, these so-called safe haven stocks are just as overbought as the momentum index. In fact, valuations are now touching the highest in the last 20 years. If there's even a hint that we are on the other side of this slowdown, these stocks are going to get slammed. Trust me, the next leg of the bull market is not going to be led by Coca-Cola. Of course, no discussion about this market would be complete without looking at the 800-pound gorilla in the room, Washington. The administration is focused on downsizing the federal government. That's pretty well understood. This chart is the reason why. The interest on our debt has gone parabolic and is now higher than what we spend on defense. Obviously unsustainable. And as some strategists like former hedge fund guru Ray Dalio have pointed out, it may be the biggest threat we face as a nation. Now, the methods and legality of this downsizing, they're all legitimate arguments, but the necessity is undeniable. DOGE is another part of this. But let's be honest, one man's waste and fraud is another man's paycheck. You can bet if a shutdown of a division or an agency in Washington, there is some company in Texas that is losing business. Again, maybe the process is flawed, but the waste and inefficiency that's been uncovered should be a concern for all. Tariffs are the biggest reason for the sell-off this week, in part because we don't know the end game. We know there are 25% tariffs on cars, but we're still unsure what the across-the-board tariffs to be announced on April 2nd are going to look like. In the absence of that information, volatility spikes as capital moves to the sidelines. We saw some of that today. The administration has made it clear that when it comes to tariffs, they want reciprocity. We should take them at their word. Again, you can be for or against this process, but it's important to accept that it's happening. Now, the key for portfolio managers like me is to gauge whether this will be a one-off process or the start of a tariff war with no end in sight. I believe, in the end, leaders will get together and negotiate a settlement that both sides can accept. Markets don't live on policy alone. Technology, especially AI, is rewriting the playbook. AI and how it's going to affect our lives, that's undeniable. The technology is moving at light speed and will be a driving force of our economy for decades to come. However, the investment into that technology goes through phases. And right now, we may be at a fork in the road. There is evidence that the initial phase, the build-out of infrastructure, may be slowing. The early part of the AI trade was focused on chips and data centers. And while both are growing, the rate of change for that growth may be slowing. Some companies like SNX have reported recently a slowdown in their order book for products related to data centers. Now, on Friday, part of the sell-off was driven by an important artificial intelligence IPO getting the Bronx cheer. For months, Wall Street had been waiting for the debut of CoreWeave, a software solutions and cloud services company. They focus on engineering, assembling, and running state-of-the-art infrastructure at a massive scale to meet AI workloads. In part, due to a shaking market, bankers downsized the offering, even cutting the price, and that still wasn't enough to attract buyers. It opened in the red before clawing back to unchanged, unusual for what was supposed to be a red-hot IPO. That disappointment showed that there was a lack of interest, and that forced even more selling of tech on Friday. Next week will be important. We have 2 positive catalysts and 1 negative. Let's start off with the bad news first. Sometime soon, the layoffs in Washington are going to start to show up in jobs numbers. Now, whether that's next Friday or the following month, it is coming. Recession concerns are starting to rise, and we saw that in Friday's action in bond markets. On the heels of a hotter than expected inflation print, which typically would have forced yields higher, bond yields across the curve fell, convinced that the economy was going to cool faster than expected. A month ago, no one was expecting the Fed to cut, and now odds are rising. Let's end this podcast with a glass half full framework. The good news is that a lot of the selling in the last week has its roots in the end of quarter rebalance, which should be complete by Monday's close. Second, for better or for worse, we should get more clarity on tariffs Wednesday when we get a look at the actual tariff structure the administration has in mind. Lifting the veil of uncertainty could be the spark this market needs to find its footing, and maybe its next leg higher. Well, that's it for this week. If you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is The Money Runner.